We certainly see it today in market prices and in everything that's happening. There are three, sometimes maybe we could stretch that to five, big things that are happening, and they are reflected in market prices, and the dynamics behind them and their change will be reflected in changes in market prices. And those three big ones are, first, that which is happening with money and credit. In other words, when you spend a lot more money than you earn, then the government does that. That means that a lot of money is printed and it moves its way through the system in a way that is reflected in market prices. And so that is what is happening now. The second is the very large internal conflicts that we're having that are due to wealth gaps, political gaps, and so on, that influence the left and the right and the dynamic between them. That affects tax policies, that affects capital flows and the like, and they're reflected in market prices and will change as those circumstances change. And the third big influence is the rise of a great power, China, to challenge the existing leading power and the existing world order. And that is being reflected in market prices, but will be reflected more as those circumstances change. The other two that have been reflected through history, and I didn't have a full appreciation of until I studied the last 500 years of history, those two are technology and inventiveness changes. We're accelerating the rate at which they are occurring, and that adaptability and change is affecting our lives in big ways. So you cannot ignore the technologically and inventiveness changes. And the fifth are acts of nature. You know, the one thing that was interesting to me when I studied the last 500 years of history is that acts of nature, and they could be climate related, droughts and floods and pandemics, had cost more lives and toppled more civilizations than anything else, including wars. So they are something that comes along irregularly. You know, when you have the pandemic or the drought or that event that comes along once in 100 years or so, they have had big effects too. So pandemic is a reminder of those. But those are the drivers, and they will remain the main drivers. And as they change, prices will continue to change. I think you have to look at the dynamic behind those prices, and I think I would look at them a bit differently. Regarding the dynamic behind those prices, it is that we are spending more than we are earning by a lot, individuals and the country as a whole, and that we need money, partially because of the political issues, partially for all the reasons that you know. So a lot of debt is being created that is also producing the need for a lot of money. And as a result of that, we have very negative real interest rates. Real interest rates of short-term interest rates are significantly negative, and even bond yields, real bond yields, are over 100 basis points negative. And so when one looks at the return of owning those bonds, that is a very bad return. It means that if you save in those assets and you put it away, that you will lose buying power at probably a rate of 3 to 5% per year. We can guess what inflation is, and we could talk about that, but you will lose that. And that tax on your buying power makes one not want to be saving in those assets. It makes one want to borrow in those assets, and the availability of credit and that set of circumstances drives money into other assets, and those assets are investment assets as well as goods and services. And so what we see now is that stocks are not expensive, not very expensive, maybe a little bit more so than normal, relative to bonds, which are very expensive, but still not expensive in relation to cash. And so they are all having expected returns that are comparatively low, and we have an inflationary period. So it's very important to understand the paradigm that we're in and how that dynamic works. And so as the inflation pressures become an issue and we have relatively, let's say, stronger growth, those things will start to change. And so the big question that the markets look at is how will that change? As a result, will the Federal Reserve and other central banks begin to tighten monetary policy? Because these things will change. And what will tax policies be and the like? And those things will affect market prices going forward. It's unsustainable. There's always, throughout history, a debtor and a creditor. And there's always, throughout history, the ability to create demand by creating debt and by creating money. And then there become clear preferences for doing one or the other. There are environments like the late 1970s when Federal Reserve Chairman Paul Volcker tightened money and wanted to make it good to save and bad to borrow and have credit. That set of circumstances was caused, and that action was caused by things that happened before it, high real interest rates and the like, and that produced the environment that we had, largely the disinflationary environment that followed. Similarly, the 1960s led to the 1970s. The 60s had too much debt creation due to war in Vietnam and what we call guns and butters policies that were spending more than we were earning. And that led to the necessity in 1971 for the President of the United States to acknowledge that they would no longer be able to pay the dollar claims in gold and to default on the gold claim and to devalue the exchange rate and to devalue the dollar, which led to the 1970s, inflation and so on. So there are always, all through history, the dynamic in which there are high real interest rates and it pays to be a saver for some times. And there are times when there are very, very low real interest rates and the need to create a lot of money and credit. And it pays to have assets, the opposite side of assets, positioned in the opposite way. And that's been true throughout history. And that's the main driver. So I think when we look forward, we can use those as guides to what's likely to happen in the way of excess return. It's in fact the way the system works. In other words, investors, borrowers and lenders look at the relative expected returns of cash, bonds, and other asset classes and move their money between those things based on the relative pricing. And that's why, for example, when there is a rise in interest rates, a tightening of monetary policy, and short-term interest rates rise relative to longer-term interest rates, so the yield curve begins to flatten and so on, that we see that there's a slowing in the economy and a slowing in capital availability, lending, long-term lending. There's a shift to saving, and as a result, there's a slowing of the economy. That's, to me, how the system works. The market is like it's like a poker game. I played the poker game for over 50 years, and I'm saying it's a zero-sum game relative to what's priced in, and the smart people take money away from those who are less smart. And that's the way it works. I wouldn't be in the business unless that was true. The dollar as a reserve currency gives one the ability to print the world's money. It is both a good and bad thing. Being able to create debt gives you the buying power. Being able to print the world's currency, such as when we were in the COVID crisis, and being able to print the currency that around the world will be accepted, allowed us to sell more debt, because when you buy debt, it's somebody else's currency. In other words, when one owns debt, the buyer of that debt is owning your promise to deliver them currency. And when you have the world's reserve currency, it allows you to get into more debt. Now, getting into more debt has historically, if not done correctly or not done sustainably, in a way it creates obligations to pay back. And those obligations to deliver currency and pay back have produced different types of problems in the future. So debt is very short-term stimulative and it's longer-term depressing, and the ability to do that and have others take on our liability. As John Connolly said when he was the Treasury Secretary and the dollar was devaluing and a risk, the dollar is our currency, but it's your problem. it's a net benefit, but like most things, it's cyclical because you have to pay back and it produces problems sometimes when you pay back. So the United States is more indebted as a result of it being a reserve currency. And it all depends on, who's going to get stuck with that. There are two main sources of inflation. There's the usual supply and demand for goods, cyclical inflation, so that when there's a demand for something, that there can't be a greater amount of supply being produced for it. There's an upward pressure in that price. And so that comes from strong demand pressing up against capacity limitations. That's cyclical inflation. And it depends on how far the central bank accommodates that. So that's the cyclical inflation. The second is monetary inflation. When the production of debt is large, but the central bank produces more money and credit, that has the effect of devaluing the value of money and credit, which doesn't look like it is going down as much as it looks like other things are going up, so that you see things going up as they are now, and that's monetary inflation. I think right now we have both cyclical inflation and monetary inflation, so that if you look at the demand for everything, right now, the demand is greater than the capacity. It's really an excess demand issue provided by a lot of money and credit being put out. And we also are running large deficits. And as we start to look farther forward, we have these very cheap interest rates, which means that it pays to buy things like, let's say, houses. Practically, there's no interest rate to speak of. And now a lot of loans are made on interest-only loans even. So with hardly any interest rate and not having to pay back principal payments in terms of the amount of ridiculousness that it's gotten to that way, there's a lot of demand for those kinds of things. Now that could be cyclical, but I don't believe when I look forward that our deficits will be primarily cyclical. So I looked into the issues of politics and the issues of the deficits and the needs for money and credit, or the desires for money and credit. And I think that they'll be structural. And I think then also there are certain changes in expenses. For example, while I believe that climate change and moving to cleaner energy and other such moves is very good for our ecosystem in the long run, it's also very expensive and it makes less efficiency. So that's going to, at that same time, add to inflation. So yeah, my worry or belief is that that will increasingly be built into the process, which we're seeing, for example, in terms of changes in compensation, changes in many, many things. Everybody's seeing inflation around them, and it's not just something that's going to settle back. So if I take the cyclical piece, it's going to require enough of a tightening, if you were to deal with that in monetary policy, to stop that buying. And the consequences of that would be very bearish for markets. And it would be very bearish for the economy. And I believe too bearish for the Federal Reserve to want to tolerate. And that would only deal with the cyclical inflation pressures, whereas at the same time, we have the structural issues of those kinds of deficits that need to be monetized. So for those reasons, I don't believe it's transitory, that we will go back to what we experienced before. It's like a disease that happens over and over again. There's a process. Everything that happens has a cause. And by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work. When there's a certain rate of debt growth that is unsustainable and that there's going to be a problem paying it back, you could see that you have a problem. When you start to have a debt problem and you're close to zero interest rates, that means that the central bank, the Federal Reserve's ability to deal with that won't work. You'll hit zero. And then you enter a new world. Okay, the last time that happened was 1928 to 1929, 30, 31. That's what happened. What happened in 2007 and 9 was the exact same thing. A debt crisis, too much debt, and you hit zero interest rates and out of luck. And then what happens, there's a classic way of dealing with that, is that the central bank has got to print money and go buy financial assets. And so that's what all the entities did. And so by being able to watch it day by day as to how they went about doing that, allowed us to navigate the crisis so that we could see the rates of deterioration and then the actions taken to end that in much the same way as the Federal Reserve ended it in 1932, 1933, for the same reasons. Now that printing of money causes financial assets to go up in price, puts money into the economy, and produces the type of reaction that we've now seen in terms of that economy and those markets. Then we're at the stage of the cycle where we are now. And what happens, classically, is that those financial purchases help those who have financial assets more than they help those who don't. It causes a greater wealth gap. And very classically, that causes populism. And then you move into a situation that's very similar. So being able to see mechanically how that dynamic worked allowed us to navigate it well. The early part of the debt cycle is the great part of the debt cycle because the borrowing of money is being put into assets that are going to be able to pay back that debt and grow, and asset prices go up. Then you enter the bubble stage when everybody is extrapolating that because it happened in the past. Because those assets went up, they're going to continue to go up and they're going to continue to rise, and it pays to borrow money to do it, but they're not able to actually pay off their cash flow. The top of the cycle usually happens when the bubble exists and also the Federal Reserve or the central bank begins to tighten money to slow that bubble at the high part of the cycle. So as we take a look at that, we are approaching more of the top of that cycle. I don't think we're there yet. I think we're in the seventh inning. When you have that tightening and then you have the turn down, I'll call the depression phase, that depression phase happens because you hit zero interest rates and because they're less effective in monetary policy. That's why 2008 was like it was in much the way 1930 was. And so that's the depression phase. In my opinion, on this long-term debt cycle, we are relatively late in a longer-term debt cycle. We're relatively late in a business cycle. That doesn't mean imminent. I mean, I think there's 2 or 3 more years probably in this. I'm not sure for sure. But we are then going to have a downturn at some point. Downturns always come, recessions always come. And what we have is a situation in which the capacities of the central banks to reverse it are more limited because interest rates are close to zero, at zero in Europe and Japan. And also, the effectiveness of monetary policy, quantitative easing, is largely behind us because they have put that money in and those asset prices have risen. We also have another issue, which is the wealth gap and the populist issue, which is, I think, worse than it was back then. They set out a path for tightening interest rates, to raising interest rates and a rate of tightening. And every track that they set out, they didn't adhere to. In other words, they tightened monetary policy much more slowly than they projected and also the market projected. And that was appropriate. I think that they're questioning their own decisions appropriately. When you hit zero interest rates, you have a different type of debt crisis. You have more likely to have a depression. So I think the period that we're in is very similar to the 1935-1940 period. Let me just explain that in a minute. 1929 to 1932, we had a debt crisis and interest rates hit zero. 2007 to 2009, we have a debt crisis, it hit zero. Then in both of those cases, there's only one thing for central banks to do, and that is to print money and buy financial assets. They print money, buy financial assets in both of those times. That pushes financial asset prices up, puts a lot of liquidity in, and also contributes to a greater wealth gap because those who own financial assets benefit when those who don't own financial assets. As a result, in both periods of time of the wealth gap and the economy not improving for a large segment of the population, we have populism. So the last time, say, when was populism popular, it would be in that period of time. That populism issue is an important issue. So as we look forward and we say, when the next downturn comes, which will happen probably in a couple of years, we're going to have a different type of downturn, very similar to the one that happened in 1937 to the 1940 period. We are in the part of the cycle now that the Fed and other central banks, in varying degrees, are beginning to tighten monetary policy. Asset prices are sensitive to monetary policy because the duration of those assets is lengthened. Central banks have to be very careful not to raise interest rates much faster than is built into the curve. But with that populism, we have an issue. So if we think about what the next downturn will be like, the downturn, I think, will be very different than the one in 2008. It'll be one in which I think that the social and political problems will be great because of that wealth gap and populism. I think there'll be more conflict. I also worry about the effectiveness in monetary policy in reversing that, because monetary policy has interest rates, and we can't lower interest rates as much, and it has quantitative easing, the purchases of financial assets to push other financial assets out and get liquidity into the system. And that is at its maximum. So when we have a downturn, we're not going to have it to be as effective. I think also the downturn in our form of debt crisis won't just be debts. It'll also be pension obligations, healthcare obligations, unfunded obligations. So I would say 2 years out is when I'm worried about, and I would think that's for these various reasons. All of these obligations will be a problem to be funded. And I think it'll be more back there of a dollar crisis than it would be a debt crisis. And I think it'll be more of a political and social crisis when we have to sell a lot of treasury bonds, and we as Americans will not be able to buy all of those treasury bonds. And if interest rates rise too much, the way it usually works is that constricts credit. We borrow less, and that creates a weakness in the economy. So instead, because we'll sell to foreigners, from a foreign perspective, when they look at it, they care not about inflation, they care about currency depreciation when they look at the interest rate. So if a currency goes down, the bonds become cheaper. I think the Federal Reserve at that point will have to print more money to make up for the deficit, have to monetize more, and that'll cause a depreciation in the value of the dollar. You easily can have a 30% depreciation in the dollar through that period of time. I just do the calculations, and the fiscal stimulation that we're having is coming at a higher rate of capacity utilization, a higher rate. And so we're getting that stimulation at the late part of a cycle. And that's a stimulant that will last. Feeling good is not an indicator of the future. Bubbles are made of euphoria, by the way, so they feel the best, right? What I'm saying is that right now the fiscal stimulus is coming in, and that's good. Productivity is enhanced by corporate tax cuts. A lot of money is going to the companies. They have lots of cash. That is good for the time being. If you do, when that stimulus passes through and then diminishes, but the borrowing doesn't. So the borrowing will be in the marketplace about that time. I'm not trying to be precise as to exactly what year or what month that has. I think we're 9 years into the cycle, and the cycles are the cycles. The balance of payments and supply, demand, and credit is what it is. And so I'm saying that we're probably in the 7th inning of this game. And therefore, I'm not particularly worried at the moment. But if I was to take, as we get to the 9th inning of the game, and the important thing, I think, is not even what I think about this. The important thing is for you and each person to really study how these cycles work. Investors have a choice of whether they're trying to be active investors in market time, which most of them are not going to be able to do well. That's a professional's game, and it's tough to do it as a professional. And then there are emotions and all of the things that enter into that. So I would say that generally speaking, they should not be actively trying to invest, or if they do, I would not recommend it, but if they do, then they have to go opposite their instincts, buy when the blood is in the streets and sell when times are good. But what I would say is important is to be able to know how